Let us see the next question. It is a question from November 2020 examination. Question number 6b. Management of multinational company TL Limited is engaged in construction of infrastructure project. A proposal to construct a toll road in Nepal is under consideration of the management. The following information is available. Initial investment will be purchase of equipment costing 250 lakhs of dollar. Economic life is 10 years. Depreciation on the equipment will be charged on straight line method basis. Earning before interest, depreciation, tax, amortization to be collected from the toll road is expected to be 33 lakh US dollar per annum for 20 years. To encourage the investment, Nepalese government is offering 15 years term loan of 150 lakhs US dollar at an interest rate of 6% per annum. Interest is to be paid annually. The loan will be repaid at the end of the 15 years in one tranche, that is in one stroke only. The required rate of return for the project under an all equity financing is 12% per annum. Post tax, highlight the portion post tax. Cost of debt is 5.6% per annum. Corporate tax rate is 30%. All cash flows will be in dollar currency. Ignore inflation, fine. You are required to advise management on the viability of the proposal by using, highlight the portion, APV method, adjusted present value method. Given PVIFA at 12% for 10 years. So cost of capital 12% and a time period of 10 years. Information is provided to us regarding the annuity factor. It is 5.65. And say for 12% for 20 years, it is 7.469. PVIF is given 8% for 15 years. For 8% and N is 15 years. 8.559. And PVIF at 8% for 15th year. Okay. So all these are like PVIFA. So one is PVIF is given. So cost of capital is 8% and for 15th year PVIF is given 0.315. Please go through the question. So friends, over here there is absolutely a new concept that we have, and that is given a name as adjusted present value, APV. How to make the calculation of the adjusted present value? So I am explaining that to you. For that, I am giving you some explanation this way. Basically friends, what happens that we have studied, say, a capital structure theory at our intermediate level, given a name as the net operating income approach, NOI approach. NOI approach or Modi-Gilani-Miller approach, in that we have studied that say whenever the income tax is introduced, at that time value of the levered firm is greater than value of unlevered firm. In that case, overall cost of capital of levered firm is less than overall cost of capital of unlevered firm. Why? Because of the interest tax saving advantage. If you remember, so the kind of calculation that we were making was like this: value of the levered firm is equal to value of unlevered firm plus present value of interest tax saving. And as far as the present value of the interest tax saving is concerned, It was calculated in this way, if you remember, that interest tax saving divided by rate of interest. What is the interest tax saving? It is interest into tax rate, that is the interest tax saving divided by rate of interest. So this is the present value of the interest tax saving that we have. So this amount is added to the value of unlevered firm to calculate the value of levered firm. This is what we have studied, and based on that concept we have adjusted present value. Now friends, APV में क्या किया जाता है? Understand carefully. Assuming that पूरा का पूरा प्रोजेक्ट हम लोग इक्विटी से फाइनेंस करेंगे, ऐसा करके एनपीवी कैलकुलेट किया जाता है सबसे पहले, और वो एनपीवी को एक टेक्निकल नाम दिया जाता है, उसको टेक्निकल नाम दिया जाता है बेस एनपीवी। बेस एनपीवी का मतलब क्या हुआ? अज्यूमिंग दैट से हमने 1 रुपया का भी डेट फाइनेंसिंग नहीं लिया है, वी मेक द कैलकुलेशन ऑफ द एनपीवी ऑफ द प्रोजेक्ट। उसके बाद later on we understand that say actually we have raised the debt financing. So what we will do, we will add present value of interest tax savings. We will add present value of interest tax savings to the base NPV to make the calculation of the adjusted present value. This is the way APV is calculated. So let us answer the question. Working note number 1, calculation of depreciation. So as far as depreciation is concerned, it is cost divided by number of years. We have been provided that the cost is 250 lakhs and the life is 10 years for the purpose of claiming depreciation. So 250 lakhs divided by 10 years. Dear students, we are making an initial assumption that there is say 100% equity financing for the purpose of doing answer. 25 lakhs per year. So this is the first working note, depreciation. Working note number 2, calculation of cash flow after taxes before interest. Yes. Why? Because we are having an assumption that say there is 100% equity financing. So whatever the loan amount which has been given to us, that we have to ignore it for the time being. So that is calculation of cash flow after taxes before interest, year 1 to year 20. So 1 to 10 and 11 to 20. Earning before interest, depreciation and taxes. That is an amount of 20. Sorry, 33. That is an amount of 33. Now from this, depreciation is deducted. So we get earning before interest and taxes. Then we make it post-tax. Tax rate is given 30%. So earning before interest and after taxes, that is 70%. We add back depreciation to make the calculation of cash flow after taxes before interest. And importantly friends, it will be discounted with the cost of unlevered equity. You can see that say over here, very well language of the question is provided to us in the example, in which say they have used the word as required rate of return for the project under all equity financing is 12%. So when there is 100% equity financing, then you require 12%. When you change your capital structure, then you may recall that your expectation, that is expected rate of return, will increase with the increase in debt financing. However, that we do not have to consider it for the time being. Okay. So now we'll discount this cash flow after taxes before interest at 12% to calculate base NPV. So 33 minus depreciation, amount of depreciation is 25. So operating income is 8, 30% is 6. So 8 into 0.7 is 5.6. Depreciation is a non-cash item, so it is added back. So it comes to 30.6. For the remaining 10 years, what will happen? 33 minus 0, so it is 33 into 0.7, 23.1. This is again 0 and this is 23.1. This is the way the cash flow is calculated for the remaining 10 years. So now we done calculation of base NPV. In that write down year 1 to year 10, year 11 to year 20. It is cash flow after taxes before interest. Friends, you remember that in ratio analysis you used to learn, all of you, NOPAT, net operating profit after taxes. It is exactly the same thing. Instead of profit, it is a cash flow. So for the first 10 years, it is 30.6, and for the remaining 10 years, it is 23.1. We will have discounting at the rate of 12%. So over here, the discounting factors information have been given over here. So for 12%, you can see that say for the first 10 years it is 5.65, and for the remaining 10 years it is 7.469 minus 5.65. So it is 1.819. Okay, so this is 1.819 for the remaining 10 years. So 5.65 and for the remaining 10 years it is 1.819. How this is calculated? 7.469 minus 5.65. Now we'll compute the present value. And dear students, as I told you, assuming that say the entire investment is made by equity shareholders, we'll make the calculation of the base NPV. So 30.6 into 5.65. So 172.89, 23.1 into 1.819. So 42.0189. So this is the present value of the cash inflow. That comes to 214.9089. In comparison that the investment is 250. So whatever the NPV that we get is the base NPV. See, the word base is indicating that say without taking into account the advantage of the financial leverage, this is the NPV that you have. So it is your name as the base NPV. Is this 35.0911. This is the way the base NPV is found. Next, heading right down, calculation of present value of interest tax savings. So in that it is very simple, dear students. Working note number 1, calculation of pre-tax cost of debt. Because dear students, what happens that we are required to discount the interest tax saving with the post-tax cost, with the pre-tax cost of debt financing. You can see that's over here. It is supposed to be discounted with the rate of interest, and the rate of interest is always pre-tax. In this question, we have been provided with the information about the post-tax cost of debt financing. So we are required to convert that into pre-tax. This is given post-tax. So that is required to be converted into pre-tax term. So write an answer. Post-tax KD, cost of debt financing, is equal to pre-tax cost of debt into 1 minus tax rate. So this is required to be found as balancing figure. Pre-tax cost of debt is equal to post-tax cost of debt divided by 1 minus T. That is the way it is supposed to be converted into pre-tax term. So what is post-tax? 5.6%. What is income tax rate? Income tax rate is 30%. So please use your calculator. 5.6 divided by 0.7, that comes to 8%. And that is the reason, friends, we have been provided with the information about the discounting rate at the rate of 8%. Luckily, we have been given that say every year the amount of interest is same. So present value of interest tax savings, which is required to be found for the purpose of APV. It is interest tax savings into PVIFA at the rate pre-tax cost of debt for n number of years. Okay, what is the interest tax saving? It is amount of interest into tax rate into PVIFA at the rate of 8% for 15 years. You can see that the information is provided to us regarding the loan financing, that we are to, that is going to take loan for say 15 years, and the rate of interest is provided as 6%. And as I told you that say every year the amount of interest tax saving is going to remain same. Why? The reason for that is very simple. The interest is going to be paid every year and principal at the end of 15th year. That is what they have provided over here. To encourage the investment, Nepalese government is offering 15 years term loan of $150 lakhs at the rate of 6%. Interest is to be paid annually and the loan will be repaid at the end of the 15th year. So 150 lakhs, that is the loan amount, into rate of interest is 0.06, into income tax rate is 30%. So interest into tax rate, interest tax saving, into PVIFA at the rate of 8% for 15 years, which is provided over here. 8% is the cost of capital. Time period is 15 years, is 8.559. So 8.559. Amount of interest tax saving is added to the base NPV to calculate APV. Now, number of times students have a question to ask me that, sir, this amount of the tax calculation is apparently wrong. Why? Because the interest effect has not been considered. I agree with that. However, we understand that say this is what's the way we make the computation of first of all base NPV, then interest tax saving advantage is considered by us. This is what say the similar to the approach or NY approach that say we adopt. We understand that say actually what will happen when you raise the debt financing for the purpose of say financing the project. So actually the expectation of the equity shareholders will increase. How much it will increase? It will increase in such a way so that the advantage of the lower cost of the funds is compensated. Because you can see that so the rate of interest is 6 in comparison to the cost of unlevered equity of 12. So both of them will compensate against one another. The only advantage of the interest tax saving will add to APV. That is set to base NPV to find APV. So 150 lakhs into 6 percentage, that is 9 lakhs. Nine lakhs into 0.3 is 2,70,000. So 23.1093. This is the present value of interest tax saving. Now the final answer is APV is equal to base NPV plus present value of interest tax savings. The base NPV amount is 35.0911 plus 23.1093. So this 11.9818. That is the negative NPV. It is in lakhs of dollar. Negative NPV. A question is that say how the interest rate is 6 and cost of debt is 8. See basically what happens that say suppose this 6% rate of interest would not have been given, then in that case we will assume that say we will borrow at 8%. And suppose this post-tax cost of debt of 5.6 would not have been given, then in that case we have to take this 6% only for the purpose of discounting. However, the language of the question is providing to us the information in this way to encourage the investment in Nepalese government is offering the loan as subsidized rate of interest. So since like in a special case we are able to get the loan at a cheaper rate. Otherwise usually our post-tax cost of debt financing is 5.6, means pre-tax cost of debt financing is 8. So write down answer. As APV is negative, do not accept the project. So let us have a small revision of this absolutely new concept. Working note number 1 is calculation of the depreciation. Second working note is as what we do, that is usually cash flow. Third working is calculation of the base NPV, in which the future cash flows are discounted with cost of unlevered equity. Friends, it has a like very like technical name, cost of unlevered equity. Uh, your chapter of portfolio management is that is covering this concept of cost of unlevered equity also, that you can correlate if at all it is done for you. Present value of the cash inflow minus investment, that is base NPV. Next is the important working, calculation of the present value of the interest tax saving. Interest tax saving, its discounted value. For that, say first of all, pre-tax cost of debt is calculated because the post-tax is given. Then the present value of the interest tax saving, that is interest tax saving discounted in present value term. In that, very fortunately information is given that every year the interest amount is same. Otherwise, preparing a cash flow series for 15 years would be extremely difficult for anyone. So the amount of interest into tax rate is interest tax saving, that is 2,70,000 discounted in present value term. That comes to 23.1093 lakhs. Next is the APV calculation. Base NPV plus present value of the interest tax saving, that is negative, so we will advise the company not to accept the project. Write down a note for the answer. First point, base NPV means NPV of the project assuming that there is no debt financing. Full stop. For base NPV calculation, we have to calculate cash flow after taxes and before interest. Second point, APV is calculated considering present value of interest tax saving, comma, discounted at the rate pre-tax cost of debt financing. Full stop. Third point, if separately post-tax cost of debt would not have been given, comma, then we will discount interest tax saving at the rate 6%. Full stop. Further, if 6% would not have been given, comma, then ROI, rate of interest, for borrowing would be taken as 8%. Full stop. Dear students, over here, one of the very important point for you is that we have to take cash flow after taxes and before interest.